Good evening, everyone. Hello and welcome. I am Angela Dailey, WISE Co-President. Welcome to tonight's program. It's about taxes, a subject we would all love to avoid thinking about, talking about, but we must. So our objective tonight is to give you enough information to pay your fair share, our fair share of our taxes, and not a penny more. We have participants from all over the country with us tonight. So please, if you're not a WISE member, go to our website, wiseinvestors.org, sign up. The price is right. It is free. WISE has been fulfilling its mission of financial education for females of all ages and all socioeconomic backgrounds since its founding in 1997, almost 25 years ago. We do this because we're committed. We believe that managing your finances better leads to better outcomes and more options in life and the ability to fulfill your dreams. WISE works through community organizations such as Girl Scouts, Girls Inc., and University. And every year we reach well more than 1,000 with our message of financial literacy. Tonight's program is part of WISE's groundbreaking Tearing Down the Pink Wall series, whose mission is both education and inspiration. We gather the best and the brightest in financial services to inspire us all to reach our full potential. When I knew we were going to do this event on taxes, I decided to take a look at how many pages are in the tax code. Well, it's a controversial subject, but I'm going to go with the Washington Post and Forbes and say 75,000 pages. Take us 1,500 hours and 62 days of straight reading to get through it, so thank God for the experts. We have a two-part program for us tonight. First, we'll talk about taxes, and then we're going to talk to Evelyn and Marilyn about their career journeys to becoming very successful entrepreneurs. Marilyn Blank founded her eponymous firm, M. Blank, about 30 years ago. Marilyn has a CPA. She's been a CPA for more than 35 years. She has a master's in accounting and tax, and she has the designation of certified financial planner. Marilyn is very near and dear to the WISE family. She handles our finances on a pro bono basis, for which we're all very, very grateful. Evelyn is also very close to the WISE family. She's on our advisory board and helps out in so many ways. Evelyn founded her firm, Inspired Financial, to help women through transition situations. Evelyn is a very sought after speaker on all subjects related to finance and philanthropy. And prior to entering financial services, Evelyn was an intelligence officer in the Air Force, something we'll hear more about a bit later. So with that, one bit of housekeeping, please put your questions in the Q&A box, not the chat box, and we will get to them after the presentations. So let's start here. Let's get into this. There's a lot of confusion in the marketplace. 2020 evidently was a tax year like no other. So many changes, all kinds of acts passed by Congress brought more money into the system. So one area of real confusion seems to be the stimulus checks. Who was to get them? How are they to be handled on our taxes? Marilyn, could you guide us through this? What's up with all of this?
Hello. Hi, Angela.
Yeah, there you are. You're on.
You can see me?
Yes, we can see you, and loud and clear.
Good. Okay, good. Yes, 2020 and now 2021 has been a crazy year for tax law. There's been so many tax laws written, changed, rewritten, reversed, and it's still happening literally as we speak. Last Thursday, the American Rescue Plan was passed, and that provided for the next round of stimulus checks. Tomorrow, March 17th, St. Patrick's Day, you're going to get your next pot of gold, possibly. And that's when the stimulus checks from this next round are going to be deposited to those who had their bank account information directly deposited into their bank account if you included it on a prior tax return. Those who will get it are those who have adjusted gross income of $75,000 or less for a single person, or $150,000 or less for married filing jointly. This stimulus payment, though, is going to be much larger than the rest, not only per person, but it's also going to include kids that it did not include before, and it's going to include college students. The other bad part about it is that it phases out much faster than the other stimulus payments. So for a single person, once you hit 80,000, you don't get the stimulus check. And for a married filing jointly, once you hit 160,000, you do not get the check. So the most important thing is that you look and see what your adjusted gross income is. That's what's going to drive this. And if there's a way that you can get your adjusted gross income down, then that's going to provide a lot of benefits for you. For many other aspects also of your tax return, a lot of things, a lot of calculations are driven by your adjusted gross income. Here's just a really quick example. Someone today, their adjusted gross income, a family of 5, was $163,000. We suggested, and they are eligible to contribute to IRAs, traditional IRAs, $13,000, because one is over 50. And so that brings their adjusted gross income down to $150,000. They now can get $7,000 of stimulus payments, and they can get $3,000 federal tax savings. So for their $13,000 deposit into an IRA, they're going to get $10,000 back. So it's definitely a win-win if you plan and strategize and make sure you know your adjusted gross income. The second part of the stimulus payments is that last year, some people got them in May and in January of 2021. Those were sent to you based on either your 2018 return or your 2019 return, again, based on your adjusted gross income. But they're actually calculated based on your 2020 tax return. So if your adjusted gross income went up, went down, you may be eligible for more. You may not have been eligible at all. And in that case, you got them, you get to keep them, whatever those amounts were, and you do not have to pay them back, and they're not taxable. But you may be eligible for more. And if you are, on the tax return, there's a recovery rebate credit that will could be calculated for you to get some more of the stimulus payments from 2020, May and April, May, when those got sent out, and then recently in January.
Whoa, Marilyn, that sounds terrific. Sounds like a windfall and not taxable.
Right, not taxable. None of it's taxable.
Terrific. Well, wow. So great information. Thank you so much. Okay, Evelyn, I'm going to stick with stimulus payments now for this. So we have a lot of people in this country with a little extra cash, and they have also a little extra time because they're not commuting, they're working from home. So we have a whole new group of people entering the stock market. I read that there are 10 million new accounts opened last year, 10 million. And I also read that they expect that with this next payment of stimulus, that $170 billion going to enter the stock market. Okay, so what do all of these people who are perhaps new to investing, trading, what do they need to know for their tax returns in terms of capital gains, et cetera? And as a second part of this question, would you give a little advice here to people that are new to the market? Because I never forget a phrase that I heard, Wall Street phrase, that don't confuse a bull market with genius. So Evelyn, help us out here.
Sure. So the first comment I would make for all those stimulus checks, chances are they shouldn't be going in the market in the first place. I would look at them steely-eyed, square in the face and say, how's your emergency fund looking right now? But in case they've got all of their other financial house in order, and this truly is money that they can put into the markets, something that you need to keep in mind regarding investing in the market, particularly if you're enamored with short-term trading, day trading, looking for those great hot stock tips like all those folks that hopped in and out of GameStop earlier this year. Keep in mind that any gains that you make on an investment that you have owned for less than 12 months there's a price to be paid on those capital gains, and it's pretty onerous. The capital gains taxes on investments owned less than 12 months is your ordinary income tax rate. So whatever your highest marginal tax bracket is, that's what you're going to pay on the gains in that investment. To put that in comparison, if you held that investment for more than 12 months, you would be paying at a more favored tax rate of 15% or perhaps even lower, depending on what your income level is. So something to keep in mind. And if you happen to hit it really big and you were one of those GameStop heroes, if your adjusted gross income is greater than $200,000, any investment earnings or gains above that $200,000 level have an additional 3.8% net investment income tax thrown on top of it. So we always joke, don't let the tax tail wag the overall investment dog. However, there is something to be mindful of regarding taxes if you're going to be realizing some short-term gains. Now, if you place that bet in the stock market and you weren't quite as successful and you ended up with a loss, the bad news is that you only can deduct up to $3,000 a year for that loss. And so if you lost $10,000 on an investment, you can only deduct that loss up to $3,000 a year if beyond what you have to offset gains. And so the government is willing to hit you hard on those gains if you win in the market, but if you lose, they make you pay for it slowly but surely over the years. You know, Angela, you said, so what about a tip? What about some advice for folks getting into the markets into the first place? And I would agree that, you know, just because the bull market doesn't equal genius. And I would also say, don't be distracted by shiny objects. You know what I mean, right? With shiny objects, there's so many of them. Everybody's got a great hot stock tip, but I guess my advice or my suggestion would be, what's this investment about? I mean, if this is fun, if this is like Vegas, okay, go for that shiny object. But if this is serious, if this is money that you would like to invest for your retirement or to send a child to college, well, then be serious about it and do your homework and consider more than just a single stock, but perhaps invest in a mutual fund that's going to buy dozens, if not hundreds of companies. So you own the winners when they go up and only a tiny slice of the losers when they're dropping.
Oh, Evelyn, that is great advice on really approaching, if it is a game and you can afford to lose the money, go for it. But if you're serious about investing and saving, go with a more serious approach. Okay, another fallout of the COVID is so many people working from home remotely. And we have, there are tax deductions for home offices, but I know I've been working at home for many years and I know there are all kinds of rules. It's not just because you have a home office or you work on a couch somewhere that you can deduct it. So, Marilyn, you want to talk a little bit about the rules relating to deductions for home offices?
Yes. So many people are working from home. A lot of people, more than ever, probably ever in history, are working from home. Some people like it, some people don't. But if you're a W-2 employee, you get no benefit from working from home. In the past, before the 2017 Tax Cuts and Jobs Act, you could deduct a home office if your employer required you to work from home. And it was also very limited. It was a 2% miscellaneous itemized deduction. So again, it had to be more than the total deduction had to be more than 2% of your adjusted gross income. Again, you want that to be as low as possible for other tax benefits. But in the Tax Cuts and Jobs Act, they said, we're throwing out all the 2% miscellaneous itemized deductions. That's home office, investment advisor fees, tax preparation fees, all of that in that category no longer exists. California does allow it, but again, you still have to be more than 2% of your adjusted gross income. So it's a bit of a hard hurdle to get over with a home office. You can do a home office and where it's going to really benefit you if you're self-employed or if you have your own business, an LLC or an S Corp. If you're self-employed, that's going to be the best benefit. You have a Schedule C. Your net income is subject to self-employment tax. The home office will reduce the net income on your Schedule C and will also reduce the self-employment tax, will bring down your adjusted gross income. So there's no reason to be scared of a home office. The IRS doesn't overly audit those. Some people are afraid that they're going to be audited because of that. Totally legitimate, as long as you have no other office somewhere else. And again, if you're self-employed, it's really a no-brainer. There's a simplified method and there's a more complicated method where you do have to depreciate your home. But either way, you should definitely take a look at taking a home office. But unfortunately for the W-2 employee, no benefit, no tax benefit. The benefit is you get to stay home, you get to work in your pajamas, you don't have to drive, you save money on gas, and there's probably other benefits too. So you just have to take those benefits instead of the tax benefits.
Okay, so what you're saying, Marilyn, is that even though people that were required to work from home because they couldn't go to the office, they can't deduct it? Did I understand that?
That's correct.
Oh boy. Okay, that's interesting.
But they could, if their employer is amenable to this, they could ask for reimbursement. They could ask for, submit an expense report and ask for a percentage of their electricity or a percentage of their internet or their cell phone usage, because most people who are working at home are now using their cell phone more for work. That is what's called an accountable plan. So it's just an expense reimbursement. It's not taxable to the employee and it's tax deductible to the employer. So that would probably be the best bet that W-2 employees should do.
And Marilyn, I'd be interested to hear your thoughts on something we've encountered with a handful of our clients that their employer is in one state, but now that they're working from home, they're working in a different state. And so there's some tax, maybe some landmines associated with that. Have you encountered that? What do you think about that?
I'm aware of it. I haven't encountered it yet, but a lot of the states, as they have been probably the last 5 years, they're grabbing at all the income they can. So if you got stuck working in a state because you had to shelter in place and you happen to be at your vacation home, that state is possibly going to be looking at some income from you from working in their state during COVID. So it's a complicated area when you get into multi-state taxation. But yes, it's definitely something that needs to be looked at, especially if your employer is in a state, if you're not working in your home state, if you're working in another state than where your normal home is. So
more and more complications. Well, one tragic fallout, of course, of this COVID is the unexpected deaths of so many. We have the count now is over 500,000 Americans. So many people are inheriting much sooner than they would have wanted or liked or expected. So Evelyn, what do we need to know about the estate taxes and inherited retirement accounts so that we are smart about paying taxes on all of this?
Sure. I'll start with the inherited retirement accounts because this is likely going to impact a lot more people than an estate tax situation. There was a change in the law in late 2019 that was seismic in how it impacts inherited IRAs. Prior to that time, if you inherited an IRA, you were required to take a minimum distribution every year based on a table that the IRS published and your age and or perhaps the age of the person that died and left you that IRA. That's all changed now. And effective January 1st of 2020, if somebody died and left you and you're a beneficiary of that IRA, the broad rule now is that you have 10 years to distribute that IRA fully. There's not a required minimum distribution, You have 10 years to distribute it, and you can do that at any interval that you would like. So that could be annually, that could be 1/10 annually, it could be all of it in year number 10. So the bad news is that by year 10, though, it's out, and there could be some pretty serious tax consequences as a result of that. Now, there are exceptions to that. The one exception is if the spouse inherits an IRA, then there's this doesn't apply in that situation. If the beneficiary is disabled, that doesn't apply. If the beneficiary is within 10 years, this is kind of an interesting idea. My sister died and left me her IRA. I'm the older and more beautiful sister by 5 years. And so with less than 10 years, then I would not be required to distribute that IRA within a 10-year period of time. Also, minor children are not required to distribute it within 10 years. However, once they each reach the age of majority, then that 10-year clock starts. And so this is a real shock to folks who inherited an IRA, thought they were going to have their lifetime to be able to distribute it, and then discover, oh no, I have to distribute this pretty quickly within a 10-year period of time. There are planning opportunities around this. This is where it's important to consult with your planner or with Marilyn, your CPA, to get some ideas about what's the best strategy for your specific situation as far as taking those distributions within the 10 years. On the estate tax side of things, the vast majority of us are actually not going to be impacted by estate tax at the federal level. The estate tax is 11.7 or 8 million. It increments a little bit every year. So it's right in that range right now. And so if somebody tragically died in 2020, unless they had an estate above that level, they are probably not going to be facing a federal estate tax. Now, you mentioned, Angela, we have guests from all over the country watching us today. And unfortunately, that's not uniform at the state level. Some states have a are in conjunction with the federal limits, and other states like Oregon are not. And so it would be really important to check with your estate attorney to find out exactly what is your state's specific estate tax situation.
So these are a lot of complications, a lot of things to keep in mind, but there are ways to lessen the pain of this, and you should talk to your accountants and your planners, et cetera. So let's stay with the retirement issue, and there are two questions here. One, Evelyn, a lot of people were furloughed, lost their jobs, and their retirement saving plans were derailed. Get off track. Do you have any suggestions for us in terms of trying to get them back on track so that we can be well prepared for retirement?
Yeah, what a hard year. It was like from bad to worse on so many levels. And many Americans who are very disciplined about saving for retirement found themselves not only in a position that they couldn't save, but their retirement savings were at risk of being depleted just to maintain their lifestyle. And so a couple of things. We were telling folks, if you have lost your job, the first thing to do, of course, or if you're furloughed or if a family member's lost a job, certainly stop the retirement savings in the first place. Don't try to stretch that at this particular moment. If things have gotten really tight, the next place might be to go look for a loan within your 401k plan. If you're still employed, that would be a place to go, because most 401k plans do allow that. The next place to go might be if you had been contributing to a Roth IRA. Normally, we say the last place you're ever going to want to distribute is from a Roth IRA, but if you are in a really tight financial situation, one of the good things about a Roth IRA is the contributions that you've made into a Roth IRA are distributed penalty-free to you. And so if you are in a really tight financial situation, you can take out your Roth contributions and not have to pay taxes on those. The last resort would be to take distributions out of an IRA or a 401k. And the reason I say last is not only do you get smacked with taxes associated with that, and there was some special tax relief that was afforded if you had to do that last year. But you also, and most years would also have to pay a 10% penalty. And so it was bad to worse as far as not only having to pay taxes, but then getting hit with a penalty at a moment that you didn't have much money, spare money rolling around anyway. Now, if the situation's a little different, where perhaps you've lost your job, but your spouse still has a job, and maybe the finances are okay, but you are out of work right now and you're really feeling it because you were very disciplined about saving. Well, a nice thing to remember in that situation is that if you are not working, but your spouse is, then you are still eligible to make a spousal IRA contribution. And so that would be up to $6,000 if you're under the age of 50, or $7,000 if you're over the age of 50, assuming your spouse has made more than $6,000 or $7,000 for that year. So there are some options available if you are needing to tap your retirement for financial support, or if you'd like to continue saving for retirement, but you are out of a job right now.
So am I understanding correctly? You mentioned that you could, in this past year, 2020, you could take money out of your retirement accounts penalty free, but when do you have to pay it back, or you don't?
Oh, yes, well, you don't. And I'll tag team a little bit with Marilyn here because I know she's got a lot of experience with this too. Marilyn, actually, why don't you lay the groundwork on it? Because there were some pretty complex rules associated with this.
Right. So in 2020, if you were affected by COVID, now obviously we were all affected by COVID in some way, shape, or form, but this is very specific. If you had a family member that had COVID, if you had to stay home to take care of kids because of COVID, you had to be directly impacted by COVID, and you could take out up to $100,000 from your IRA, and if you're under 59 and a half, without penalty. And now that you've taken it out in 2020, you have the choice. You can either have it all taxed in 2020. You can divide it over 3 years, have it taxed over 3 years. You can pay it back within the 3 years, and you can decide in the third year. So if you decide to split it up and have the $100,000 that you took out divided over 3 years, you pick up income this year, 33,000, next year, 33,000. The last year you say, oh, I've collected enough money. I want to at least put 50,000 of it back. You can go back and amend your returns. If you want to put all of it back, you go back and amend your returns and not have to pay any taxes on that money. So you have some opportunities. I don't know that a lot of people knew that they could do that. Mm-hmm. So I don't see that it was widely done. Mm-hmm. But when I have seen so far this year, someone who did take out a withdrawal, I did ask, why'd you take it out? Were you affected? Even if they took it out and they didn't even know about this law, there might be an opportunity to be able to divide that taxable income over 3 years.
Right. There's another interesting provision among the many stimulus packages that were passed last year. And that was, of course, that folks that were required to take a distribution from their IRA that did not need that had the option of either not taking it at all, or if they'd already taken it, putting it back in to their IRA. And this was the case for many folks that were in a good position financially, that they didn't need to take that. But something that we've discovered that I think is important for the folks on the webinar today to know is that when you take a distribution out of a retirement account like an IRA, the custodian's going to issue you and the IRS a tax form called a 1099-R. And so if you took out that required distribution, or a distribution from your IRA last year, you're going to get a 1099-R that says you took out money from your IRA account. Now, if in 2020 you said, hey, wait a minute, I don't need this money, and you put it back in, you are not going to get an amended 1099-R that shows that it went back in. And this is actually really important for you to talk with your tax preparer, your CPA, about this, and tell them that this has happened. Because if all you give them is a 1099-R, they're going to assume that you took a distribution, and it's going to be added as taxable income to your income return, your income tax return.
Yes.
What your CPA would do is just treat that as a rollover back into your IRA. And you obviously would have documentation via your statements and also via what is called a Form 5498, which you're going to get in May-ish this year. But obviously that's too late to make your April 15th deadline. So just be sure you tell your tax preparer if you ended up taking an RMD and putting it back in last year so that they know to treat it as a rollover on your tax return and you're not going to be taxed on it.
Yes, but this is how they need to treat it as a rollover. So if you call it a rollover, you put a special code in the tax software and it doesn't show up as a taxable distribution. That's going to be a problem. So don't tell your accountant that you rolled it. Tell them that you put the money back in within the allotted time. But here's your 1099. The 1099 is going to say you took out $25,000. We need to still report that on the IRA line that says 25,000, but on the line 21, other income, put in a minus $25,000 and say IRA rollover within 60 days or within allotted time. Because if you just tell the computer software, oh, this was a rollover, it's going to show it as zero taxable. That line is going to be zero. And it's not going to match up with the 1099s that the IRS got, and you're going to get a notice. So it's best to put it on two lines. Taxable, back it off as non-taxable.
Whoa, it's a good thing we have these experts here. That is pretty complicated. But just to be clear, nobody was obliged to take a required minimum distribution in 2020. And if you did, is it too late to put it back? Or for that?
It's too late to put it back unless you took it out on December 30. Oh no, we're past 60 days. So it's too late. It's too late now.
So you lost out if you.
Yes. And required distributions are now required again for 2021. So it was only for 2020. So that has passed. But kind of going back to what Evelyn was talking about on the IRA, the short window, the 10-year payout of an inherited IRA. This last year was a good time, and maybe 2021 will also be somewhat of a good time to start looking at your IRAs to see if you can start doing Roth IRA conversions. That means your IRA is going to, whatever you convert to a Roth, it's going to be taxable. But if you start managing, again, your adjusted gross income, your taxable income, know what tax brackets you're in, you can maybe do that at a very tax effective cost. Because when you think about it, if you have, if you're in your early 70s and you have children that are in their 40s or 50s that are very successful and in the top tax bracket, maybe a higher tax bracket than you are, it might be worth it to start doing Roth conversions, taxing that money now at 22%, so that when your children inherit it and then they have to take it out over 10 years, they're not going to be paying 50% taxes on it. So that's another kind of thing to start looking at with Roth IRA conversions, kind of a good way to prevent or do some tax planning with this 10-year payout for non-spouse beneficiaries.
Evelyn, is there anything you want to add to that with all of the clients that you have? I'm sure this is a big issue with them, this Roth conversions.
Yes, we did a lot of work, like what Marilyn was describing at the end of the year last year, because there was at that time a window with folks that had not had to take required distribution. So we did a lot of Roth conversion analyses and sometimes just accelerating income out of, or accelerating income, bringing it out of the IRA and placing it into, say, a trust. Now, this year is going to look different for so many reasons, because the requirement to take a distribution is in place again this year. And so that extra income, that whether or not you need it, is going to be coming out of those IRAs. But every person's situation is very different. And this is one area that I always say, talk with a professional to help you with this, because there's still opportunities to do analysis and see. We call it filling up tax brackets or filling up tax buckets, if you will, to get you to the top of your current tax bracket, but not pop you into the one above it. So there are still some terrific tax planning opportunities around Roth conversions or accelerating IRA income.
And they need to be done, obviously not on the 31st of December.
No, don't make yourself or your professional team crazy doing that. We start doing all these analyses in October. And the reason that it's hard to tackle it earlier than that is that if you have investment accounts, that your investment account will probably generate investment income late in the fourth quarter. And that obviously is going to impact what your taxable income is going to be. So we need to have an estimate of that before we can start really crunching the numbers, but it does not need to be in the back half of December. It could be before then.
Way before then.
Right.
Way before then. So another big fallout was the closing of schools and children working from home, and needed to be supervised, and increased childcare expenses. Now I know that the CARE Act has a lot of implications for this, including, I don't know if it's for this year or last year, this greatly increased tax credit for children. Who wants to take this one on what additional deductions people may take because they had to incur more childcare expenses or just stay home and supervise the children?
Well, I can tell you that unfortunately it was in the American Rescue Plan, and it's only for 2021.
Oh, 2021.
So they've increased the child tax credit. They've increased the child dependent care credit substantially, but it's only for 2021, which really doesn't make sense. They're changing things from year to year. So why, when we just went through 2020 with people having to stay home with their kids not being in school, and this year kids are going back to school for the most part, why they didn't do it for 2020, don't know, but they have changed it for 2021.
So people cannot take advantage of any of this for last year.
No.
Well, that is odd, isn't it?
Yeah. And the other weird thing that they added to the American Rescue Plan related to this child tax credit, which is going from $3,000 to $3,600, and there's some other new rules related to it. They want the IRS to set up an advance payment where the IRS will send you 1/12 of that estimated child tax credit every month starting in July.
Wow. So
right now the IRS cannot open their mail. They cannot answer their phones. They're so buried with work. And yet this new plan says, send everybody 1/12 of their $3,600 child tax credit. I know it'll be very, very helpful to a lot of people, but the problem is, I don't know how the IRS will even program this, will know how to do this. And again, they can't right now deal with their basic daily duties. So it's kind of, but it'll be good when you file your tax return. There are definitely more credits, definitely more daycare credits available.
2021. Yeah. 2021. Yes. Well, okay, let's go on to perhaps a happier aspect of all of this. People became much more generous in giving in 2020. So let's talk about how do you maximize giving strategies so that the charities get as more and more, and taxpayers are able to maximize this on their returns. Evelyn, do you want to take this one?
Sure. It was truly moving. There was so much need, and it really can bring out the best in Americans, and to see us rally like that. And so, yes, a lot of charitable giving last year, and more this year. And there's actually some terrific opportunities to do well, being generous, and also have some tax benefits, really optimize or leverage your giving. So one, that is particularly applicable this year, now that required distributions are back in play, is to make what is called a qualified charitable distribution, or a QCD for short. And that is that you can make a distribution out of your IRA directly to a charity, and that can count toward your required minimum distribution, and it's tax-free. So when you make the distribution, you are not actually going to have to pay taxes on it. So say, for example, you had a $15,000 required minimum distribution, and you decided to go ahead and make a $15,000 donation to Meals on Wheels. And you had that made directly out of your IRA. Meals on Wheels gets the benefit of the $15,000 gift or donation that you've made to them. You satisfy your required minimum distribution, and you don't have to pay taxes on that distribution out of your IRA. So it's a win all the way around. Another way that folks can make gifts and have it be a win all the way around, similar, is gifting appreciated stock. So let's say you were one of those GameStop winners earlier this year, and you held your stock for at least 12 months. And I'll tell you why that's important in a moment. If you have appreciated stock, I'll give you another example. I have a client who, as a young woman, was gifted shares of Johnson & Johnson stock when it was about $4 a share. And now, of course, Johnson & Johnson stock is much, much more expensive on a per share basis. And she really loves the Kennedy Center in Washington, D.C. And so she could gift shares of Johnson & Johnson stock to it. And so let's say she's got $50,000 worth of Johnson & Johnson stock that in the original gift was worth $1,500. But she can make that gift of $50,000 of appreciated Johnson & Johnson stock to the Kennedy Center, and she would get credit for the $50,000 gift, and she didn't have to sell it and realize the gains on that to do that. So really powerful to gift appreciated stock, but something to keep in mind, back to my joke about the Game Stoppers, is that you have to, some folks don't realize you must own that stock for at least 12 months to be able to take the appreciated value. Mm-hmm. If she'd owned that Johnson & Johnson stock for only 10 months and had paid $1,500 for it, and it was now worth $50 when she gave it to them, she would only be able to deduct the cost basis. She'd only get a $1,500 deduction for that gift. So make sure you hold that stock more than 12 months if you're going to gift appreciated stock. Another that we like, and I'm sure that Marilyn sees a lot of these too, are what is called a donor advised fund. This is an opportunity for you to make a contribution into a fund that you can later designate where you would like those donations to go, but you don't have to right in that moment. And we see this happen a lot in maybe the back half of December. Folks want to make a donation. They are motivated somewhat by altruism, but also by a little tax motivation. And they say, I don't know what I want to do with it. Well, a donor advised fund is a terrific place to place that gift for now, and then you can later on designate to the fund where you would like that donation to go. And so we see that, and that's a pretty cost-effective way. There are some minor fees associated with setting those up and maintaining them, but they're a really nice way to make a gift when you're not quite sure where you ultimately would like that to go. So a handful of different ways. One other that I always like to remind folks is when you are thinking about setting up your own estate plans and naming beneficiaries for your IRAs, and maybe if you have a trust, naming beneficiaries of your trust, is if you are charitably inclined and you plan on leaving a chunk of change to a charity that's important to you, you might want to talk to your planner and your CPA about perhaps naming that charity as the beneficiary of your IRA, because the money that passes from, as we talked about earlier, if it passes to a person, they've only got 10 years to take the money out of that, fully distribute that IRA, and they're going to pay whatever the ordinary income tax rates are at that time. Whereas if you gift the money or donate the money to a charity by naming it as the beneficiary, that passes to the beneficiary without any taxes. It just, whatever the value is, can go to them. And then you can balance that out by naming the rest of your estate to go to the people that you love and would like to leave a bequest. So there's some complexity there, but it's a very powerful way to get money in the hands of those causes that are important to you. What do you think, Marilyn? Did I miss anything there?
No, so just a couple things. Sometimes people don't want to do the donor advised fund. So what I do tell them, because the standard deduction has now been raised to a much higher amount than it was before the 2017 Tax Cuts and Jobs Act. So for a single person, it's now 12,000. It used to be 6. And for married, it's about 25,000 when it used to be 12. So a lot of people aren't itemizing their deductions anymore, and charitable contributions are within the amount of the itemized deductions. So for people who do want to continue to donate, I tell them to bunch the deductions the contributions in 1 year and skip a year. But you can do it where it doesn't really affect the charity. So donate to them in January and then December of the same year. So to them, it's almost like they got it, annually. And so when you do it in January and December of the same year, you've got 2 years worth of deductions, but it all falls into one tax year. So it might get you over the standard deduction. So that's one thing. The other thing, just from a CPA point of view, when we're trying to do a tax return, prepare the tax return, when you do donate out of your required minimum distribution IRA, the brokerage firm still gives you a 1099 for the amount of your RMD. So you have to tell us that you made charitable contributions out of that IRA and provide us with the documentation. Otherwise, we do not know. And when you do that, again, instead of having $15,000 of an IRA distribution, and if you gave $15,000 to a charity, it nets to 0, and we can report it correctly. And it also brings down your adjusted gross income. If you took out your RMD and then wrote a check yourself, you would have your adjusted gross income would be higher by $15,000. And you may not get the benefit of that charitable contribution because you might not be itemizing, you're taking the standard deduction. So that's why it's another good reason to donate out of your IRA, but you also need to tell the accountant, because we're not going to know, because the brokerage is going to send you a 1099 for $15,000.
Oh, there's a lot to consider here. I mean, it sounds complicated, but really in essence, it isn't. Just that you take it out of your IRAs, give it directly to charity, don't pay taxes on that. And in terms of the donor advised, there's a lot of flexibility here. So all great advice, especially in these years when, Evelyn, as you point out, so much need. Okay, so now let's look ahead here with paying for all of this stimulus. I don't know, what do we have, $4 trillion? Some incredible amount of money that went out in the stimulus. So somehow it's got to be paid back. Somehow we got to deal with this. So there's a lot of discussion about tax law changes. I think you both alluded to this, that we need to expect that taxes will be going up. And you also alluded to the fact that probably one big place it's going to be is the estate planning area. So Marilyn, Evelyn, what are you hearing in the marketplace among your colleagues and peers about these changes in estate tax? And you did mention that there are ways that people could potentially protect their estates from some of this. So how about doing a little crystal ball here?
Okay, Marilyn, break out your crystal ball. Go ahead.
I wish I had one, because I would have known everything that just happened this last year. It's so hard to predict, but yes, they're already talking about the tax law changes. They're definitely going to reduce the estate tax exemption, which, as Evelyn mentioned earlier, is $11.7 million per person. They're probably going to bring it down to either 3.5 or 5 million, which still sounds like a lot of money, but for people in California, it's really not, because the housing prices here are very high. And so your house is worth a lot. People who have worked for a long time have amassed a lot of money in retirement accounts. So it is a little bit scary that they're going to be reducing the estate tax. They're talking about increasing the income tax on people with income over $400,000. The rate's probably going to go from the top rate right now at 37%, going to go back to what it was before 2018, which was 39.6%. Capital gains, they're eyeing for that, raising it up to, for people, again, over $400,000, it's going to be ordinary tax rate. You're not going to have a tax break. And a lot of things are going to be happening. I know they're really, really looking at the estate tax very intricately, meaning a lot of people who can gift things where they're not gifting a full 100% of their ownership can take a discount. And so they can save some money on estate taxes. They're looking at that's called a discount. They're looking at getting rid of discounts on estate plans, and a lot of very technical, high net worth individuals that are doing very complicated estate planning. They're looking at wiping out a lot of that. So
I think the trick is, well, what do you do about that? And this goes back to the cracked and broken crystal ball, because it's really risky to make dramatic changes to your financial and estate planning situation on the come, anticipating, are they going to do this? Are they going to do that? The current administration, during the President Biden's campaign, he said loud and proud, I'm going to get that estate tax exclusion down to $3.5 million. And I know when I talk with my colleagues about this, we actually, if we were going to bet, we wouldn't bet on $3.5 million. We would say probably more in the range that Marilyn was describing, $5 to $6 million, which gives Californians with our crazy housing prices a little more breathing room. And the other thing is that what we would recommend, for the ultra high net worth, they still can hire legions of tax and finance professionals to help them navigate however this is going to land. But there's a big group of people that are kind of right in the middle that are going to be right on the edge of what this might be once the dust finally settles. And in that situation, we advise our clients, flexibility is the name of the game. You really want to make sure that however your estate documents are crafted, and here in California, we joke, if you've got more than 2 dimes to rub together, you pretty much have to have a trust document, because the probate process is onerous and expensive here in California, unlike a lot of other states where it's easy peasy, not so much around here. Well, what you want to do is you want to make sure you're talking with your planner and your estate attorney and your CPA about the language in your estate documents, specifically your trust, to make sure that it allows flexibility to adjust to whatever is happening in the regulatory or the legislative environment, because it's changing pretty fast and furious. And I'll tell you what's frustrating is to spend the money to update your estate documents, and then 18 months, there's another big change in the law that you have to go and rewrite the whole darn thing because the one that you created 18 months ago isn't flexible. So for all of us that are sort of in the middle there, I'm really encouraging our clients to talk with your estate attorney and make sure your documents are flexible to work with whatever comes down the pike on this. And then be careful about jumping the gun. Don't go crazy, make yourself crazy, trying to guess what this is going to look like. Give yourself a little bit of breathing room. And also, we're not betting on anything in 2021. Candidly, the current administration has a few other things going on right now that estate tax revisions is probably a little lower down the list. And so we probably have just a little time before this is going to fire up again in all earnest.
So to be clear, right now, the deduction of the state exemption from estate is 11.5 per person. That's 22,000, right?
11.7. Yeah, 11.7. So right in that range.
Yeah.
Give or take a few hundred.
Give or take a few hundred. So if it went down even to 3.5, it would still be 7 million per couple.
Per couple. Mm-hmm.
Per couple. So that's important. Mm-hmm. And I guess what you're both saying, especially you, Evelyn, is don't put up any irrevocable trusts
Not just
Very
that.
careful about that, because I don't know, but it seems like in the past few decades, this number has jumped around a lot. It has jumped around a lot. Well, we're very close here. We've been through most of the questions. So I think maybe at this point, I'm going to turn this over to my co-president, Darlene March, who's going to field some questions. And then let me just say that after that, we're going to take questions for about 20 minutes or so. And for anyone that would like to stay, that's when we're going to talk for a brief period, 15 or 20 minutes, to Evelyn and Marilyn about their careers and how they built a very, very successful businesses for themselves. So Darlene, take it on.
Hi. Hello, everyone. Am I getting the speaker view here?
Yes, you're all set. You're done.
Okay. I just want to make sure I'm on. And we have some very good questions. We have about 9 really good questions, and I hope we can get through all of them. But I think the most important question here is Seema said, this is a great panel and the host. Is it possible to receive the speaker's point of contact info and their field of expertise? I am looking for a CPA to handle my taxes. So is there a way we can get these ladies' contact info on the screen, or how can we do that? Because
maybe Casey can put it on the website.
Yeah, that's.
I will send out an email to everyone afterwards.
Oh. Okay.
Okay. All right. And this is going to be recorded. So if you missed anything, we can catch it all later. Okay. All right. Now let me start with the first question. Might be the easiest, Marilyn, and because I think you answered this during your talk. The check payments, the stimulus payments, are they based on AGI 2019 or 2020?
Okay. So the ones that are being sent out right now are based on 2019, unless you've already filed your 2020 tax return. So the problem with that is that the IRS didn't even start opening up electronic filing until February 12th. So we haven't gotten through a whole lot of individual tax returns. A lot of documents are coming out late this year. So this stimulus payment is probably mainly based on 2019, unless you've already filed your 2020. So you may want to look at 2020 and determine if you will be eligible if you file 2020, and you should then file 2020 soon, or if your income went up in 2020 and you would be better off using your 2019 information, then do not file your tax return, your 2020 tax return, until closer till April 15th. And even then, you may even want to file an extension. If you do owe money, you do have to file, or you do have to pay what you owe on April 15th, but you can file an extension to file your tax return later. And that might also work. It's after they do the direct deposits, which is what they're doing now, they're going to be mailing checks out, and it's going to take a couple of months to get all these checks out. I think the first round, it took a couple of months to get checks out. So.
Okay, I hope that answers your question, Majed. Elizabeth has a question, and she's not sure if this is the right forum, but I think you could probably answer this quickly. She's 65 and she's working full time, and she wants to put off taking Social Security until she turns 70-ish. And because she's afraid that maybe the government is raiding Social Security to and the money won't be there, is she wise to wait until she's 70?
Yes. And in case I wasn't clear on that, yes. I highly encourage you to wait. And I know you've done your homework already, which is why you're considering that. But the risk to the Social Security kitty for somebody in their 60s is very minimal. You know, if we're going to see any adjustments to Social Security, it's not going to be for folks that are within a year or two, or even 5, or maybe even 10 years. of Social Security for retirement age. And the reason for that is that the government has to address this issue, but they want to do it in a manner that doesn't penalize people that do not have time to be able to make an adjustment, to make a course correction, so to speak. So, Elizabeth, if you were 35 years old and asking this question, I might have a different answer for you, but because of your age, I would say, yes, you will be just fine. You can hold off until age 70 with a pretty good level of confidence that your Social Security benefits will be there and ready for you to have a great retirement when you turn 70.
Thank you for that great advice, Evelyn. Okay, here's another question. If you don't have children and are in your 60s, is it wise to start doing a WISE conversion? I'm sorry, a Roth conversion.
It's wise to convert to WISE.
Yeah, right. Do it. Yeah. Is it wise to start doing a Roth conversion when you're in your 60s and you don't have any kids?
Oh, and you don't have any kids.
Yeah.
I don't see why you would want to do that then.
Right. I would agree with that, unless nieces, nephews, some other person that you would like to do this. But otherwise, Marilyn, my inclination would be in that situation to start exploring charitable giving. I would say let's not do distributions to do a Roth conversion, but let's take a look at, are there causes that really are important to you? And let's see about maybe taking some distributions out of your IRA to make some charitable donations. But otherwise, just based on that little bit that you shared with us, I would not suggest that you need to make Roth conversions.
Okay. Let's see. The questions are disappearing as I, okay. Does the this is the payback. I'm not sure what the payback is. Start after the third year or within 3 years. Are we talking about?
So you must be talking about the IRA withdrawal during COVID.
Okay, all right.
No, you have to start paying it. Well, you can pay it back anytime within the 3 years. You have 3 years to pay it back. Until then, you have to pick up at least a third on each of the next 3 this year and 2 more years tax returns. So you can decide at the end to pay it back at the 3rd year, but not after that. You have 3 years.
All right. Okay.
Or you can choose to report the whole income, all of the income this year, and still in 3 years pay it back, and then you can go back and amend this year's tax return.
Great. Okay, and what if I qualified for the first stimulus check, $1,200, but did not receive it since my taxes were filed too late to show my lower income? Is there any way to receive that money? And I think you did address that. You might.
So on your 2020 tax return, it's all going to get reconciled. And if you're owed more because your 2020 adjusted gross income is down, then there's this recovery rebate credit that the software that you're using or your accountant will be able to calculate for you. So you need to make sure that you let your accountant know. This has been a great kind of a lot of work for us, because we ask the question and people aren't remembering, don't know if they got their stimulus checks, don't know how much their stimulus checks were. And so the IRS has a nice little they did have a nice little website that said, they didn't tell us how much, but it said that when you got your first one and when you got your second one. So we could at least confirm, because we had a lot of people telling us, I didn't get the second one. But a lot of times the second one may have come as a direct deposit and the first one may have come as a check. The second one also may have come as a credit card. People don't realize that a lot of people got little credit cards in the mail that were actually your stimulus payment. So we can at least confirm on the IRS's website that you got one and you got number two, and on the dates. And if we think it's an amount less than the full amount because your adjusted gross income was in a phase out range, we can ask you for the exact amount. Well, as of today, now that they're starting to send out the new stimulus payments, and I can't even say that word, stimulus. I don't know why I can't pronounce that. But anyway, they've wiped out the other two payments. Now, when we go online, it only shows the payment that's going out right now, which has just screwed up our whole process of trying to figure out what people got and if they got it or if they didn't get it. So we were kind of sad this afternoon when we went online and discovered what happened to the other two payments. They're not telling us anymore. So, but yes, you do have the opportunity to potentially get more of the stimulus check rebate, recovery rebate credit. There's so many names for things. There's the economic incentive payment, EIP, they're calling it that, the stimulus check. The recovery rebate credit is what you can get if you didn't get all of it. So yes, there's still a possibility.
So I would think that someone in this situation would really need someone with your expertise.
We have been having to go back, figure out, did they get it based on their 18 return or their 19 return? And then again, as I said earlier, is there a way that we can get their adjusted gross income down now so that we can get more of the prior stimulus check that they maybe didn't get it for because of prior AGI? So it's, again, all about the AGI.
All about the
AGI.
Okay, here's a good question. If you don't itemize and you take the standard deduction,
yes,
charitable contributions like electronics, luxury items, deductible?
So for 2020 only, in one of the bills, maybe the consolidated, the CAA that happened in December, the Consolidated Appropriations Act, is allowing a $300 above the line charitable contribution, but only if it's cash. So if you are taking the standard deduction, you're not itemizing. If you did contribute $300 in cash to any charity, you can take that as an above the line meaning it's going to reduce your adjusted gross income. Adjusted gross income is the line. So you want deductions above the line so that your adjusted gross income goes down. So this year only, you can take $300, but it's got to be cash. So if you donate it to Goodwill, that doesn't count.
So in my standard deduction, could I include in there all the
standard deduction includes property taxes, state income taxes, limited to $10,000, your mortgage interest, charitable contributions.
Okay, charitable contributions. If I gave away an electronic TV or
yes.
Would that be included within the standard deductions?
Yes, that's included in the standard deduction.
Okay, so I think that answers anonymous
okay.
attending question, because we want to bump up that level, so we can get to more than the standard deduction and maybe deduct.
Yes.
Okay, all right.
But for many, especially retired people who maybe don't have a mortgage and don't contribute a lot to charity, they're not going to get over that standard deduction. However, they may be able to get over it for California. So don't forget about California. A lot of people aren't giving us all of their charitable contributions or stuff. But I'm taking the standard deduction. I know, but the standard deduction for California is much lower than the federal. So you may be able to itemize for California, and that's going to help on California's tax return.
Okay, all right. I think some of these questions were already answered. Anonymous has asked a lot of questions. He or she said, I am in my mid-60s and have $100,000 in a money market. What should be my next step with this money? I do have children. Would be inheriting this my estate in the future. Okay, $100,000 in a money market. And what would be my next step with this money? Maybe Evelyn, could you jump in here?
I'd love to. Unfortunately, and this isn't me dodging, but it depends. So do you have an emergency fund? Are you still working? Have you maxed out your retirement savings for the year? Do you have a grandchild that you might like to help send to college and perhaps contribute to a 529 account on their behalf? There are so many things that you could do with that $100,000, but it really depends on your exact situation. And so I will get in a gratuitous plug for working with a financial planner. And for that, if you just wanted to call a planner and pay for an hour of their time to bend their ear and get their opinion on their planners, that would be happy to do that. But that kind of a blanket answer is really difficult, because you may say, well, I've already got an emergency fund. I'm all set, and I'm good to go on retirement. And then you light up and say, oh, savings for college for my granddaughter. I'd love to do that. So that might be the answer for you, which could be completely different for somebody else. So I'm not dodging your question really, but it's hard to answer without knowing a little more about the situation.
And then somebody else said, if you didn't get a second stimulus check, how do I check on it? How will I receive it?
Before today, you could have checked the IRS website and they would have told you the date that they directly deposited it to your bank account. But without that, I mean, again, if you look at your adjusted gross income, if you were below the level, which on all the checks has been 75,000 AGI for single, 150,000 AGI for married. If you were below that, you would have gotten the stimulus check. And again, the second one, it was either directly deposited, even though the first one may have been a check, or you could have gotten a credit card. And I saw someone's envelope with a credit card, and it really wasn't totally clear that that was from the government. It kind of looked like a fake, credit card thing that they send in the mail. So I'm just afraid some people may have thrown it out.
We got a lot of phone calls about that.
What?
Yeah, we had a lot of phone calls. Several clients called. Said, is this fake? This looks phony baloney to me.
Yeah, or me, I like all my bills are on auto pay. So my mail kind of just stacks up, and then I go through it months later, and you might find it in your mail basket. I don't know.
Well, let's just hope we don't throw away, valuable hard-earned money. Yeah. Okay. What are the advantages for SLAT? Do you know what that is? SLAT for married couples in California. Do either one of you know what those are?
I am not sure what that might be.
We're gonna mark that one as. And okay, so
I mean, the only thing I can think of is maybe SALT, SALT, which is state and local taxes, which got reduced to $10,000 in the Tax Cuts and Jobs Act. They're trying to get that reversed, because before we could deduct all of our state taxes, all of our property taxes, car registration, personal property taxes. Other than that, I don't know what SLAT is.
Well, I guess
it's spousal lifetime
assets trust.
Oh, okay, there you go.
Right.
I don't know.
Okay, well, that is a trust that can be created, an irrevocable trust. So once it's in place, you're done, with the intent of transferring assets outside of your estate to take advantage of the very high estate tax exclusion that's available right now. Kind of like what should I do with my $100,000? So, is a SLAT right for me? Really depends on your situation, very, very much on your situation. The good news is that you can create this trust as spouses create them for each other, and you are able to, the spouse is able to have lifetime access to the assets and the income inside the trust, but upon the death, then they pass to whoever's named as the beneficiary. But there are some pretty tight restrictions that come with that. And as with all these strategies, there's an element of control that you are giving up when you put them in place. And so whether it's a good idea for a particular couple really depends on their specific situation. If the person who asked that question, if your estate is of a size that this is a tool in the toolkit that is of interest to you, definitely get with your planner, your estate attorney, and your CPA and have a powwow to explore whether it's right for your situation. This is one situation where time might be of the essence, because if it is the right tool in the toolkit for you, it takes time to put these in place and set up the trust, transfer the assets into the trust. And while I said we don't see any estate tax changes coming in 2021, first of all, I do not have a working crystal ball, so they might surprise us with that. And secondly, if it does change, it probably would be next year. So this is not something to dilly-dally if you think that that might be a tool that you want to explore. So get with your team and get on it.
All right. Okay. Angela, I'm going to turn this over to you because we have some fantastic commentary that we want to hear from our two illustrious panelists. And Angela, you've done a fantastic job too. So thank you very much.
Well, now comes the fun part. This part, talking to our panelists about their careers and their career paths and their journeys, is a hallmark of our Tearing Down the Pink Wall series, and very, very popular portion. So I'm going to start asking both of you to tell us, bring you back to your university graduation. What was in your head? Where did you think you were going to be 10, 20 years hence? And has your career gone in a straight line? Evelyn, I know for sure yours hasn't. So why don't we start with you?
Yeah, you're right. Not at all. When I graduated from college, I had been in Air Force ROTC all through college. And so I knew when I was graduating that I was going to be entering the Air Force as an officer. And I had planned on staying in the Air Force my entire career. I was going to be a general, and who knows, I might have actually run the Air Force at some point. But it ended up going in a very, very different direction. And I actually got out of the Air Force after 9 years and was recruited, actually headhunted by a little mutual fund company out of Malvern, Pennsylvania called the Vanguard Group, and went to work for Vanguard. And of course, I had no experience in financial services. I was kind of wide-eyed about the whole thing, but Vanguard actually was a great way to enter the financial services industry. Terrific company. And they were great about training. They supported me to get my MBA in finance and portfolio management, and supported me while I was studying for my CFP designation. So when I left and started my own financial planning practice in 2003, it was, I felt as prepared as you can be when you start your own business. And so I know Marilyn has her own business, and you do everything you can to prepare, but there's always this take a deep breath and step out kind of a moment when you're starting your own business. What was it like for you, Marilyn?
Well, I was probably always on the road to be an accountant. My parents were accountants, not CPAs, but accountants. And I took bookkeeping in high school and business classes. So it was just kind of inevitable that when I went to college, I just had no other idea except for accounting, and went to work for a big 8 CPA firm. Now it's a big 4. And after being in corporate and working on very, very large clients and really not getting to know clients and working on little pieces of big clients, I just didn't like that anymore. So I just wanted to work on small clients, and took a few clients with me when I left Deloitte & Touche. And they're still my clients. Well, one's deceased, but their family is still my client. Then when you're self-employed, you just keep taking on work, because I don't know tomorrow if I'm going to have work. So sure, I'll do that work. Sure, I'll do that work. Sure, I'll do that work. And it just kept coming, and I just kept working harder, and was working out of my house and hired an employee. And then my husband was like, who is this person coming into our house every single day? Get out of here, move into an office. So it just kind of kept, again, when you're self-employed, it's just like, I don't know what's going to happen tomorrow. So yes, I'll take on that work. And you just find people to help you, and it just grows like that. Now, the problem is it's so hard to find people to help me now. It's a really, really tough business, because we have, well, all these tax laws is called the CPA Full Employment Act. That's what they are. We are busy every single day, And now it's harder because CPAs have to have 150 college hours, where a normal bachelor's degree is only 120. So now you have to have an advanced degree before you can even, so it's challenging now, but.
Well, let's stay on this topic while we're here now. So tell us more about starting your own business, because I know many people have this dream of starting a business. And tell us what it takes, what it took. And you started this already, Marilyn, work. But what does it really take to succeed as an entrepreneur?
Well, you have to take chances. You have to take chances that you don't have a paycheck. You have to take chances that things are going to work out, and you kind of have to feel lucky about it. I see people overly planning and then they don't get anywhere. So you have to plan, but then you also have to take a risk. So I, again, moved out of my home office into an office, and then people started asking us, are you guys moving? Because all of a sudden we were like outgrowing our office and there were boxes all over the place. So, in what year was it? 2003, I bought my office building. And I remember my kids saying, that costs more than our house. Don't worry about it. We'll figure it out. Everything I do is like, I don't know, we'll figure it out. And it's worked out fine. And actually, COVID kind of helped because now people are working at home, and we were actually bursting at the seams in this office. So now it's a little bit more manageable. But I think you just have to plan, but then also take risks. And sometimes when you take risks, you don't really know how they're going to pan out, but you kind of have to work toward, this is how I want them to pan out. So let's work toward that goal.
Evelyn, you tell us. I mean, you've built an incredibly successful business as well, Inspired Financial. You have a singular focus there. I know that that's not all you do, but your real focus is on women and women in transition. Tell us about what went into your mind about focus, how you built the business, and how you've managed to keep it successful over, I don't know, how many years now is it? 20 years?
Yeah, it's knocking on. This is actually 19.
Yeah, so you're and by the way, we should add that most businesses fail within the first 5 years, or is it the first 3? I don't know. They say something like 80% of people that start businesses don't make it through year 3 or through year 5. So tell us, how did you do it?
Well, I'll take a page from Marilyn's book regarding taking a chance. I think I'm going to paint a broad generalizing brush here, but women in particular, we like to know what's going to happen. We like, many of us are planners in the broader sense. We make plans, we have strategies, we want to have a really clear idea of what this is going to look like. And many of us are reluctant to move forward on something until we are really, really clear on it. We research the heck out of things sometimes. And the old paralysis by analysis can be a real challenge for women who are interested in starting their own business. And I think that take a deep breath, prepare, do your homework, but then you get to this moment that you say, okay, I'm going to go and let's see. And you step out and go. You have to go. And sometimes it goes great. And sometimes it's a little rocky. I'll tell you, to your question, Angela, about our focus. So I ended up in California in 2005. So I left Vanguard in 2002. I started Inspired Financial in 2003. I had a change in personal situation in 2004, and I'm not from the East Coast. I'm actually a native Texan, and so I was going to go back to Texas. But I'd been working by myself, and so I knew I didn't want to continue working by myself. I either wanted to find another planner and form a partnership, or maybe a small firm and come in as a partner. And I looked at some opportunities in Texas, but the one I ended up pursuing was not one I was looking for. And this goes back to taking chances, seizing opportunities, even if it's not the one you were looking for. And that was, I ended up buying another financial planning practice here in Southern California in 2005 and merged the two of them together. And I always make the analogy, when you buy another financial planning practice, it's kind of like buying a pet store. You know, when you buy a pet store, you're going to get everything in the pet store. You're going to get the dogs and the cats and the birds and the fish and the snakes and the lizards. And you may have just really wanted the birds and the fish, but you got them all. And so I had the pet store. And for the first couple of years of meeting and getting to know and learning to serve these clients, it was definitely a heads down, all hands on deck. As Marilyn was saying, work, work, work all the time, work. But there came a moment in 2007, I kind of came up for air and I was like, okay, I think I've got this under control, at least for the moment. And then I looked around and kind of surveyed, is this what I want to be doing? Are these the kinds of clients that I would like to serve? Are these the kinds of services that we would like to provide to these, our clients? And made a decision at that time that we really wanted to be specialists. We wanted to be the experts in taking care of women facing significant life transitions like divorce or death of a spouse. You know, I told you I got divorced, and it was part of this motivation for me moving to California. I'm a very smart woman. I'm a strong personality, and I'm a financial planner. And even I struggled making good financial choices when I was going through my divorce because I was so emotionally compromised, grieving a change in my life that I never wanted and never anticipated was going to happen. I just wanted to get through it as quickly as I could. And as a result, made choices that put me in a worse financial position than I needed to be. And so we decided that it shouldn't happen to anybody else. We wanted to be the ones to come alongside her and help her find her voice, be her voice when she couldn't find her own, educate her and empower her to make good choices. So she'd come out on the other side of that transition better and stronger and in a better place than she ever thought she could. Now, of course, I did this and we want comprehensive financial planning. We raised our minimums a little bit because of the comprehensive services. And of course, we all know what happened in 2008. And so it was a bumpy road. Back again to Marilyn's comment about working and you take the business you need to be able to maintain your business. But it was worth it because looking back at it now, we are the experts and taking care of these women and their families. And it feels really good to be able to come alongside them and change their lives like that. So I'm really happy. And I think that clarity is powerful, regardless of your business. Clarity about who you want to serve and how you want to take care of them is absolutely liberating because it allows you to let go, set down all the other.
So a question for both of you. Would you do it again? Would you give up the so-called security of a regular paycheck? You, Marilyn, leaving a very prestigious accounting firm. You, Evelyn, leaving one of the most famous, storied financial firms in the world. Would you do it again?
Yes.
I mean, who does that, right? Who leaves Deloitte & Touche to start their own gig? Who leaves Vanguard to start their own gig? I'm with Marilyn. Yes, yeah. I would do it again in a flash.
Absolutely.
And tell me why. What is this giving you that Vanguard and Deloitte & Touche would not have given you?
Well, I like being the boss.
I have personal relationships with my clients. I know their families. I know their whole life. I'm trusted with helping them make decisions. That's what I want to do. I want to just help people and do the best for my clients. So it's just very rewarding. And in a Deloitte & Touche, I'd be a corporate working on IBMs and the big corporations. So I like working with families and people and planning and helping and supporting clients.
It is incredibly gratifying to be able to have full control over who you work with and what you are doing for them. I joked a second ago that I would do it again because I like being the boss, and I do. I just can't imagine ever going back to a corporate environment where I'm not in charge. But all joking aside, I really love to have the ability to work with anybody we want to work with. And it's incredibly sad, like Marilyn is saying, incredibly satisfying and rewarding to be that partner and to change lives.
So given the fact that most businesses do fail, what skills, because I'm sure we have people in the audience here who are thinking about this, really would like to start my own business. what skills do you think, just give us 2 or 3 top skills that you must have if you want to be an entrepreneur and successful one?
Well, I would probably say you have to take charge of whatever it is. You have to make decisions quickly, and you have to be confident. I mean, those are probably what I would say is the most important skills from my point of view.
Yeah, and I'll add, it's really helpful to be a great communicator, to be able to convey the passion, the energy, the vision for what you see with your company is incredibly powerful, not only for finding clients, but for finding great team members, for building relationships with collaborative partners. To be able to communicate, be a great communicator, I think is very, very important. And then I think another is, in addition to the, being decisive and being willing to take chances, to be able to give yourself some grace, to not be so tied to perfection that you can't be flexible and pivot if necessary. Because if there's nothing else I've learned in the last 20-ish years of having my own business, it's to be flexible, because it's not ever going to go exactly the way I thought it was going to.
I'm glad you brought up that point, Evelyn, about communication, because one thing that all entrepreneurs need to do, no matter what business they're in, is to sell, to bring in the clients. Right. So you have to be able to communicate. And I think the passion is really the key. Both of you have a lot of passion about what you do. You care about what you do. And I have to say that being involved with WISE, you care about helping others. I mean, these 2 women that joined us tonight, as you know, they're so busy, but they took time out of their really busy schedules to do this work for us and to help, the 100+ people that signed up for this, give them a little more clarity on their taxes and just generally help them manage their finances better. So I'm going to say, we're all going to get on the screen. I'd like everybody to appear on the screen that's been involved in this: Darlene, Sonia, Casey. And we want to thank everybody for participating. A heartfelt thanks to our 2 great members of the WISE family, Evelyn and Marilyn. We are so grateful for all of your support and all of your advice to us. And please do go to our website, sign up, hear about more events, wiseinvestors.org. And any feedback that you'd like to get us, just put it on the website, right, Casey? They can put feedback there.
Yes, you can send us emails.
Yes. And on our website, there's a wealth of information, past webinars that you can see, and see many more women that have shared their journeys to inspire all of us. So hope you join us next time. And thank you so much for all of your time, everyone.
Thank you.
Thank you.
Bye.
Bye.
Bye.